Hi, this is Steve. Part two of asset allocation. Here we go. We talked about risk correlation between the two pieces in part one. So adding something to portfolio either improve return or reduce risk. Now, when it comes to essentially determining the amount of risk that you need to have based on your goals, your expectations, will determine how much you have as far as risk in the portfolio. By risk, I mean equities are going to be more risky. When you have more equities in a portfolio, more risk, more volatility, more fluctuation, more fixed income in a portfolio, more stability. So when we in the industry start putting you in allocations in a portfolio based on the amount of risk you're looking to assume, we talk about things about being ultra aggressive or aggressive when you're 100% equities. We talk about an 80-20 posture, 80% equities, 20% fixed income, where that is a very growthy, almost aggressive growth as far as an investor. You're going to get a lot of fluctuation in the portfolio, but your expectations for return are higher. Now, when you start getting to something called more like a growth in income or growth with income, we talk about it as a 60-40. So 60% equities, 40% fixed income. Then you've got a 40-60, which is income and moderate growth. And then you typically have capital preservation and income and very moderate growth. 20% equities, 80% fixed income, and 100% fixed income, which typically doesn't tend to keep up with inflation. But when we talk about those categories, let's say 60-40, this is what happens. People say, you should be taking on risk about a 60-40, growth with income. 60-40 is talked about as if it's the same thing across all portfolios that are 60-40. It's not. You can have very aggressive 60% equity portfolios, 40% fixed income, or you can have really conservative 60-40s. So all 60-40s don't sound the same, even though across our industry, all the professionals go, you should be 60-40. There's the tip for today. Thanks.